Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. If you're watching this video, I already know something about you. I would assume that you've got a family that you care deeply about, and you're probably chasing goals that get bigger every single year. You've probably been grinding and you've been building, and the last thing that you want is for some random, unexpected crisis to wipe everything that you've worked so hard to build. And if you're anything like me, you've probably got people depending on you and people that are counting on you to show up. That's why today's video isn't just important, it's essential. I'm going to show you how to protect your wealth, your health, and your family, all while building a powerful financial engine that quietly grows in the background. And no, this isn't a get-rich-quick scheme. This is a real strategy. I'll show you how to shield your money from taxes, penalties, and market crashes to get paid if you ever get sick, injured, disabled, or even worse. You'll also be able to safely grow your money over time and turn everyday living expenses into tax-free income. And here's the best part. It's all done with one single well-designed life insurance policy. A policy that doesn't just benefit you, but also sets up your children, your grandchildren, and maybe even your great-grandchildren. This strategy doesn't require you to be rich to start. In fact, it works even if you're just starting out. So without further ado, let's get right into the video. Before we get into the numbers, I need to explain what this process is called. It is the infinite banking concept. A lot of people get confused here. They think infinite banking is a product that you buy, like a special type of insurance or investment, but it's not a product at all. It's a process, a way of taking back control of the banking function in your life. Think about it like this. Most of us trade time for money. We work hard for a paycheck and then we use that paycheck to pay bills, to buy things, or maybe even save a little bit. But the money we do save, we usually put it into a bank account where the bank, not us, decides how it's used. And while the bank lends out our money to make huge profits, we're lucky if we get paid a measly fraction of a percent in interest. Infinite banking flips that script. Instead of giving up control to the bank, you create your own private banking system. You put your money into a specially designed whole life insurance policy, the machine that powers infinite banking. And that money starts growing for you every single day, guaranteed. You can borrow against it, you can use it for investments, you can pay it back on your own schedule, and the whole time, your original money keeps growing as if you never touched it. That's the key, uninterrupted compounding interest. We're going to break this down step by step, not skipping over the beginning years when the policy is still growing. That's the foundation. I'm going to walk you through what it looks like for a 38-year-old man in good health who wants to start with a modest contribution, and I'll show you exactly how the numbers play out. I'll also ensure you understand why this works, how it can be done on a smaller budget, and why the early years look the way that they do. By the end, you'll see that infinite banking is a concept anyone can use, not just the wealthy. I need to set one more thing straight before we break down the numbers. Yes, you can start infinite banking with a small amount of money, but the older that you are when you start, the more you'll need to contribute for it to work effectively. Here's why. If you're young, say in your early 20s, you've got a long runway. The money you put into the policy has decades to grow, to compound, and to build a solid cash value base. If you're, let's say, in your 60s, the runway is much shorter, so to get the same results, you need to put in more from the start. The general rule of thumb that you can use is to take your age and multiply it by 10. That's the minimum monthly contribution you should aim for. So let's say that you're 38 years old. You need to put in around $380 a month. If you try to do this with, let's say, only $280, the numbers just wouldn't work well enough to allow a meaningful borrowing and repayment within the policy. So again, for our case study, we're going to use $380 a month as the starting point. So here is the policy setup. Meet cash policy A. Let's give our hypothetical policyholder a name. We'll call him Mr. 38. He's a 38-year-old healthy male and doesn't use tobacco. His annual contribution is $4,460, which is split into monthly premiums of around $380. Now, here's an important detail. Part of that $380 is going towards a term insurance rider, which is about $30 a month. That rider exists to keep the policy from becoming taxable. I'll explain why that matters in a bit, but the remaining $350 a month goes directly into the whole life insurance portion. Now, I'm sure you're asking, why include the term rider at all? Well, when you're overfunding a whole life policy, which is what infinite banking is all about, you're putting in more than the base premium so you can build cash value faster. But if you put in too much compared to the death benefit, the IRS considers it a modified endowment contract or an MEC. That changes the tax treatment and ruins the advantages that we're after. The term rider increases the death benefit temporarily, which keeps the policy compliant until it's grown enough to stand on its own. So let's start with year one, the so-called ugly year. This is where most people misunderstand infinite banking. They expect the policy to give them back every dollar they put in right away, and when it doesn't, they assume it's a bad deal, but that's not how this works. In year one, Mr. 38 puts in $4,560 total. By the end of that first year, his cash value, the amount of money he can actually use, is under $3,420. That's about 75% of what he contributed. Some people see this and think, wait, I put in almost $5,000 and only have access to $3,420? That's terrible. But if you compare that to a 401k or an IRA, when you contribute to those, you're giving up 100% control of your money until you're nearly 60. Mr. 38 is giving up control of only 25% for a single year, and after that, things start to actually get better. Also remember, cash value is simply the equity you have in your death benefit. In this case, the death benefit starts at $108,000, and $3,420 of that is available to use right away for anything. No restrictions, no penalties, and no taxes when accessed properly. Now let's talk about how the banking concept works inside the policy. This is where the magic happens. When Mr. 38 uses that $3,420, he's not taking his own money out of that policy. His money stays inside, compounding and growing. Instead, he's borrowing against the death benefit from the insurance company's general fund. They charge him interest for the loan, but meanwhile, his entire cash value keeps earning dividends and interest as if he never touched it. That's exactly what banks do. They take in deposits, that's your money, pay you a small interest rate, then loan it out at a higher rate. The spread is their profit. With infinite banking, you are the bank. Your premium payments are the deposits. Your cash value is your capital. And when you take a loan, you're just leveraging that capital to make more money than the loan cost. Now, let's fast forward to year two. Mr. 38 is still putting in the same $380 a month. By the end of the year, his cash value grows by $4,560. This means he now has about $7,478.40 in cash value available. More importantly, he's now keeping about 89% of what he puts in each year. In year one, he gave up control of about 25%. Now it's only 11%. The gap is starting to shrink very fast. By year three, Mr. 38 puts in another $4,560 and gets about $4,332 in new cash value. And by year four, he hits break even. Every new premium dollar he puts in shows up in the cash value portion. At that point, he's putting in $4,560 and instantly having access to that $4,560 all tax-free. That's the turning point. From here on, his policy is fully capitalized. Every contribution adds directly to what he can use, and the growth continues to compound on the full balance, whether he borrows against it or not. And now let's just fast forward to year 10. This is going to be the growth curve, and this is where things get exciting. By now, Mr. 38 is 48 years old. The term insurance rider that he needed in the early years has dropped off. That happened in year 7, once the policy had enough death benefit to stay compliant on its own. Without that extra cost, his annual contribution dropped slightly to $4,200, but here's the exciting part. In year 10, the cash value grows by $5,997.76. That is a net gain of $1,797.60 on his $4,200 contribution, which works out to about a 42.8% return on that year's input. Remember, that is just the policy's internal growth. He could also borrow against that cash value and use that to make even more money elsewhere, stacking returns on top of returns. Now, let's put this into an actual practical scenario. At the end of year 1, Mr. 38 had $3,420 in cash value available. Let's say he decided to borrow against it to pay off a personal loan that cost him $250 a month. He sends that $3,420 to the lender, wipes out the debt, and then redirects the $250 monthly payment back into his policy loan. Over a year, that's $3,000 going back into his own system instead of to a bank. At the same time, his policy is still growing from his regular premiums. By year 2, he's got that $3,000 back in his control, plus the $4,560 in new growth from his contributions. That's $7,560 available in 2 years to use for the next move. Maybe now he takes that $7,560 and wipes out a credit card balance that cost him $300 a month. Suddenly, between the personal loan and the credit card, he's recapturing $550 a month that used to leave his household forever. So this is the key takeaway. It's not about how much you start with, it's about consistently redirecting money you were losing to outside lenders back into your own system while your total capital continues to compound untouched. And yes, if Mr. 38 had started with, let's say, $40,000, he could have moved much faster. But even starting small, the results snowball. The early years are about capitalization, building the foundation, and once you hit break even, every year just keeps getting better. And remember, all of this is happening in a protected environment. Cash value inside a properly structured policy that's shielded from lawsuits and creditors. It grows tax-free and loans are not a taxable event. That's why this strategy is so powerful. Now, I want to pause and address the biggest mental roadblocks that people hit when they look at a policy illustration like this, starting with what happens if you never repay a loan. So if you borrow money against your policy and never repay it, the simple answer is the outstanding loan balance is deducted from the death benefit when you pass away. So if Mr. 38 was to take out a $10,000 loan and he never repaid it, and his death benefit is $108,000, his beneficiaries would receive $98,000. The trade-off is that during his lifetime, he had the use of that $10,000 to invest, grow a business, or cover expenses, while the rest of his cash value kept compounding. Most people want instant gratification. They're used to swiping a credit card today and paying it off later. They want to see dollar for dollar access for that first month. But infinite banking doesn't work like that. In the beginning, part of your premium goes toward the cost of insurance and building long-term structure of the policy. That's why in year 1, you're only seeing around 75% of your contribution available as cash value. You're building the framework that will support decades of tax-free growth and liquidity. Think of it like this. If you were planting an apple tree, the first year you dig a hole, you plant the seed, you water it, and you protect it. You don't expect to be making pies the next day, but give it time and that tree starts producing fruit every single season, far more than you could ever get if you tried to buy apples one time at the store. And that's the power of compounding inside the policy. Now, I'm sure everybody watching this video knows who Albert Einstein is. Einstein's theories of relativity fundamentally change our understanding of space, time, and gravity and the universe. No one knows what his IQ was or how smart he was, which is for me irrelevant. I don't believe in standardized testing. I don't think that's a big measurement of anything, but I think the man was pretty smart. Albert Einstein said, "Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it." That's where infinite banking gets exciting. Once your policy is capitalized, the cash value keeps compounding on every dollar that's in there, whether you've borrowed against it or not. Imagine you take a policy loan to invest in something else. Maybe you buy a piece of equipment for a side business, or you use it for a down payment on an income-producing property. Your cash value inside the policy still grows because you didn't actually take money out. You borrowed against it. Your cash value inside the policy still grows because you didn't actually take money out. You borrowed against it. And if your outside investment produces a return higher than the interest on that loan, you've just layered an additional profit stream. This is what I mean when I say you can stack returns on returns. Your money is doing 2 jobs at once, compounding inside the policy and producing results outside of it. Even starting small, the principle is the same. The more money you can put into the system, the faster it will grow, and the sooner you'll be able to use it for bigger opportunities. If you guys like this infinite banking concept, let me know. I'll be happy to make more videos like this. Maybe next time we can actually find some specific examples of everyday people and look at some hard numbers. All the examples I use in this video were obviously fictitious, of course, but the concept itself is the most important part. There are 2 responsibilities I believe that every man has, or anyone that leads a household. Number 1 is to protect your family, and number 2 is to provide. You protect your family from harm, and you provide them with opportunities. Most of us do this by going out, by making money, maybe building a business, or working hard in your career. Either way, the information I provide about finance are just tools that help you do those 2 things. You don't have to use every tool in your toolbox, but it's good to know that they're available if you need them. Once again, thank you so much for watching this video, and you guys have a wonderful day.